Imagine it is 1980. You're a grain farmer in Iowa. Over the previous decade, you did exactly what every signal in the economy told you to do. The Federal Reserve kept borrowing costs at historic lows through the 70s. The Secretary of Agriculture went on national television and told farmers to plant fence row to fence row. Your bank called you personally and urged you to buy the neighbouring plot. So you borrowed, you expanded, you bought machinery, you bought land at prices the market said were fair. You were not greedy, you were rational. Then, in the span of 18 months, the Federal Reserve raised interest rates from 9% to 20%. The same institution that built the floor beneath your feet pulled it out. Your loan payments tripled. Land prices collapsed by 40%. The bank that called you personally has now sent a certified letter. You sat at your kitchen table surrounded by a decade of work and realised a terrifying truth. You were never responding to a real market. You were responding to a signal that was manufactured and then deliberately destroyed. The prosperity was not earned, it was lent. And the institution that lent it to you held the switch the entire time. This is not a uniquely American story. This is the operating pattern of every central bank in the modern era. The crisis always follows the credit, and the credit always comes from the same place. And when you understand the mechanism behind that pattern, you will never look at an interest rate announcement the same way again. The most important price in any economy is not the price of oil, not the price of labour, and not the price of housing. It is the price of borrowing. The interest rate is the price of time. It tells every business owner, every investor, and every government in the world how expensive it is to use money today that does not yet exist. When that price is honest, it reflects something real. It reflects the accumulated savings of millions of people, their collective willingness to defer spending and lend their resources to productive enterprise. A high rate means savings are scarce, and capital is precious. A low rate means savings are abundant and borrowing is responsible. That signal, when left alone, is one of the most powerful coordination mechanisms in human history. It allocates resources. It separates productive ventures from unproductive ones. It tells you, in a single number, whether the economy has the genuine capacity to support new investment. Now imagine someone walks into that signal tower and starts adjusting the dials manually, not in response to real savings, not in response to real economic capacity, but in response to political pressure, short-term growth targets, and the institutional need to keep asset prices elevated. That is precisely what central banks do. The Federal Reserve sets the federal funds rate not because that rate reflects reality, but because it reflects a policy choice. And when the price of borrowing is a policy choice rather than a market truth, every single economic decision built on top of it is built on a lie. When money is cheap, it moves. That is not a theory, that is physics. And when the price of borrowing is held artificially below its natural level for an extended period, that money does not flow to the most productive corners of the economy. It flows to the most speculative ones. This is what economists call malinvestment, and it is not a flaw in the system. It is a direct and predictable consequence of manipulating the cost of capital. Consider what happened in the decade following the 2008 financial crisis. The Federal Reserve held interest rates near zero for 7 years. The result was not a surge in productive industrial investment. It was a surge in stock buybacks, commercial real estate speculation, venture capital flooding into unprofitable technology companies, and the rise of what became known as zombie corporations. These are companies that cannot cover their interest payments from their operating earnings. They survive only because the cost of rolling their debt is low enough to kick the reckoning forward. By 2023, research from the Bank for International Settlements estimated that roughly 15% of publicly traded companies in advanced economies qualified as zombies. 15%. These firms do not create net wealth. They consume it. They occupy capital, employ workers in unproductive roles, and crowd out the genuinely competitive businesses that would have replaced them if the price of money had been honest. The cheap credit did not build the economy. It embalmed it, and that is only the first problem. In 2008, the United States government made a decision. It decided that certain financial institutions were too large, too interconnected, and too systemically important to be allowed to fail. Bear Stearns was absorbed. AIG received a bailout of $182 billion. Citigroup was backstopped with a guarantee of $300 billion in toxic assets. The stated logic was that letting these institutions collapse would trigger a depression. That logic was not wrong, but the solution came with a hidden cost that was never put on the table for public debate. When you rescue an institution from the consequences of its own risk-taking, you do not eliminate the reckless behaviour. You subsidise it. You send a clear and unambiguous signal to every trader, every executive and every risk committee in every systemically important financial institution on Earth. The profits will remain private. The catastrophe will be socialised. This is the precise definition of moral hazard, and the mathematics of it are brutal. Every bailout increases the scale of acceptable risk in the next cycle. Every rescue guarantees a larger institution in a more fragile position the next time around. The 2008 bailouts did not end the era of too big to fail banking. They expanded it. The 6 largest American banks held assets equal to roughly 40% of GDP before the crisis. By 2023, that figure had risen above 60%. The institutions got bigger. The risk did not go away. In November 2008, the Federal Reserve announced a program that most Americans had never heard of and would not understand for years. They called it quantitative easing. The official description was deliberately opaque. The Fed would purchase mortgage-backed securities and treasury bonds from financial institutions, expanding its balance sheet to inject liquidity into frozen credit markets. That is the technical version. Here is the honest version. The Federal Reserve created new money, used it to purchase assets from banks and large institutional investors, and in doing so drove the prices of those assets higher. Stocks rose, bonds rose, real estate rose, and everyone who already owned those assets became significantly wealthier. Everyone who did not own them, primarily younger workers, renters, and people without investment portfolios, watched the cost of housing, healthcare, and education accelerate beyond their wages. Between 2008 and 2022, the Federal Reserve's balance sheet expanded from approximately $900 billion to nearly $9 trillion. The S&P 500 rose by over 600% in that same period. The median American home price doubled. Meanwhile, real wages for the bottom half of American earners grew by less than 15% over the same window. This is not a coincidence. It is a mechanism. Quantitative easing does not create broad prosperity. It creates a wealth gradient. It transfers purchasing power from those closest to wages toward those closest to assets. It is the most effective wealth redistribution program in modern history, and it runs in reverse. And here is what nobody at the central bank will tell you about where that transfer leads. In 1998, a hedge fund called Long-Term Capital Management collapsed. This was not a fund run by amateurs. It was run by 2 Nobel Prize-winning economists, a former Federal Reserve vice chairman, and a team of mathematicians whose models were considered the most sophisticated on Earth. Their models told them that the probability of losing more than $500 million in a single year was essentially zero. They were wrong by $4 billion. The lesson was not learned. In 2007, Ben Bernanke testified before Congress that problems in the subprime mortgage market were, in his own words, contained. Within 18 months, the global financial system had nearly ceased to function. In 2021, Federal Reserve Chair Jerome Powell told the American public that the inflationary surge appearing in consumer prices was transitory. It was not transitory. It was the highest sustained inflation in 40 years. This is not a series of unfortunate miscalculations. It is the inevitable failure mode of institutions that model human behaviour as though it were governed by fixed physical laws. Markets are not thermostats. They are the aggregate of billions of individual decisions, each shaped by fear, expectation, narrative, and memory. You cannot model narrative. You cannot quantify the moment when confidence turns. The economists running these institutions have doctoral degrees in mathematics and almost no framework for psychology. They can calculate the expected value of a position. They cannot calculate the moment when the room decides to run. And the room always eventually decides to run. There is a reason that every major currency in recorded history subjected to sustained monetary expansion has eventually experienced a severe devaluation. It is not political. It is not ideological. It is arithmetic. When the supply of money grows faster than the supply of goods and services that money can purchase, each unit of that currency buys less. This is the most documented relationship in monetary economics. Between February 2020 and April 2022, the M2 money supply in the United States increased by approximately 40%. In the entire history of the country, it had never expanded by that magnitude in that time frame. The Consumer Price Index peaked at 9.1% in June 2022, its highest reading since November 1981. Gasoline prices doubled, grocery bills surged, rent increased by double digits in major metropolitan areas across the country. Millions of working Americans who had done nothing speculative, nothing reckless, and nothing outside the normal pattern of their financial lives watched their purchasing power erode in real time. Defenders of the policy will argue that the expansion was necessary, that the alternative was a deflationary collapse. That argument has been made in Weimar Germany, in Zimbabwe, and in Argentina. Each time with different justifications, each time ending in the same place. The money printer has never been deployed in a genuine emergency without someone later arguing it was justified, and the currency has never emerged undamaged. The damage is already in the system. The only question is when it finishes arriving. By the time the Federal Reserve began raising interest rates in March 2022, it had created a problem with no clean solution. The American economy was carrying a federal debt load of approximately $30 trillion. Corporations had borrowed at near zero rates for over a decade. Mortgage markets had been priced for a world in which the 30-year fixed rate would never sustainably exceed 4%. And then inflation forced the Fed's hand. Between March 2022 and July 2023, the federal funds rate moved from effectively zero to 5.3%, the fastest tightening cycle in 40 years. The results were immediate. Silicon Valley Bank collapsed in March 2023, a direct casualty of a bond portfolio priced for a low-rate world. Regional bank stocks fell across the board. Commercial real estate entered a slow-motion repricing that, as of early 2025, had still not completed. Office vacancies in major American cities exceeded 20%. This is the trap. If the central bank keeps rates high to fight inflation, it crushes the debt-laden economy it spent 15 years constructing. Defaults rise, asset prices fall, employment contracts. If it pivots back to low rates to relieve that pressure, the inflation that was never fully defeated returns with greater force. There is no path through this corridor that does not cause serious structural damage. The central bank did not stumble into this trap. They built it brick by brick over 15 years of believing the business cycle had been permanently tamed. It had not been tamed. It had been compressed. The financial system most people interact with, stocks, savings accounts, and mortgages, is a surface layer. Beneath it sits a network of funding markets, repurchase agreements, and overnight liquidity facilities that almost no retail investor ever sees. These are the pipes, and the pipes are showing fractures. Global debt as of 2024 stood at approximately $315 trillion, according to the Institute of International Finance, representing roughly 330% of global GDP. This is not a number that can be grown out of at current interest rate levels. In the United States alone, net interest payments on federal debt crossed $1 trillion annually in 2024 for the first time in history, a figure that now exceeds the entire defense budget. The Treasury must roll over trillions in short-term debt each year, making the government extraordinarily sensitive to any spike in borrowing costs. Meanwhile, the reverse repurchase agreement facility at the New York Fed, once holding over $2 trillion of excess liquidity parked overnight by money market funds, drained sharply through 2023 and 2024, signalling a tightening in the availability of short-term funding collateral. When these markets seize, they seize fast. In September 2019, the repo market spiked to 10% overnight, and the Fed was forced to intervene within hours. Nobody predicted it. Nobody had a model that flagged it. When it happens again, the scale of intervention required will be larger than anything the system has ever attempted. The question is not whether the next liquidity event arrives. The question is whether the institution designed to stop it is the very reason it will happen. The goal of this video was never to generate despair. It was to generate clarity. Because once you understand the mechanism, you stop being a passive participant in a cycle you never consented to, and you start making decisions from a position of structural awareness. The first principle is straightforward. You cannot opt out of the system entirely, but you can reduce your exposure to its most predictable failure modes. Holding your entire net worth in cash or fixed income during a period of sustained monetary expansion is not conservative. It is a slow confiscation. Real assets, commodities, productive land, and businesses with genuine pricing power have historically preserved value across monetary regimes in ways that paper promises cannot. Gold has been used as monetary collateral for over 5,000 years. It is not an investment in the traditional sense. It is a rejection of counterparty risk. Bitcoin, now held as a reserve asset by several sovereign governments and a growing list of public companies, represents a mathematically capped alternative to a system defined by infinite expandability. Neither is without volatility, but volatility and structural fragility are not the same risk. The more important move is cognitive. Stop treating central bank pronouncements as information. Start treating them as signals of institutional pressure and political constraint. When a central banker tells you inflation is under control, ask who benefits from you believing that. When rates are cut, ask what would happen to the system if they were not. The rational actor does not trust the signal tower. The rational actor builds a position that survives whether the signal is honest or not. If this video shifted something in the way you see the system, do not keep that to yourself. Share it with one person who is still operating on the assumption that the institutions are working as advertised. That conversation is more valuable than anything a financial advisor will tell them this year. If you want to go deeper on how these cycles actually play out in real portfolios, real assets, and real geopolitical decisions, subscribe. Every video on this channel is built on the same principle. Not a prediction, not panic, structural clarity. And if you have a question, a pushback, or a country or crisis you think deserves this same level of analysis, put it in the comments.